Hey option traders, for today's trade we're looking at a neutral option play known as an iron condor in chipmaker Micron, which is set to report earnings on Tuesday after the closing bell. Shares have been rallying over the past week in strong volume as the stock retook its 50-day and 200-day lines. The RS line has also sprung higher. As we can see, shares continue to hit resistance at the 64 level here. The stock rallied over 3% last week. Now shares are pulling back to test support at their 50-day line. Earnings and sales growth have slowed and even declined in recent quarters. Micron also reported a loss in the most recent quarter of 4 cents per share. Analysts expect the company to show a loss of $3.01 for 2023, followed by EPS of 75 cents a share in 2024. As for the upcoming quarter, Micron is forecast to show a loss of 88 cents for the quarter on revenue of $3.71 billion. So how do we take this upcoming earnings event and construct an option trade around it? Well, the first thing to note is that Micron has stayed within the expected range following 5 of the last 6 earnings announcements. For tomorrow's earnings report, Micron is anticipated to stay in a 7.1% range up or down. So traders who think the stock will not move too much following this report could look to use an iron condor here. As a reminder, an iron condor is a combination of a bull put spread and a bear call spread. The idea with the trade is to profit from time decay while expecting that the stock will not move too much in either direction. An iron condor is a risk-defined strategy, which means that you know your max loss potential ahead of time and it's not unlimited. This is a great way to get exposure to a stock without taking directional risk as well. So with all that said, let's take a look at my trading platform and set up this trade.
So for this trade in Micron, we will be using the March 31st expiration for all legs of the trade. For the bull put spread, we could look to sell the 57 put and then buy the 52 put. And for the bear call spread, that could be placed by selling the 66 call and then buying the 71 call.
We'll be using the March 31st expiration for all legs of the trade. For the bull put spread, we could sell the 57 put and buy the 52 put. Then the bear call spread, we could look to sell the 66 call and buy the 71 call. In total, this iron condor will generate around $1 per contract or $100 in premium. The profit zone ranges between 56 and 67. This can be calculated by taking the short strikes and adding or subtracting the premium received. Both spreads are $5 wide, so the maximum risk in this trade would be $400. If we take the premium divided by the maximum risk, the iron condor trade has the potential to return about 25%. If the price action stabilizes in the stock, then this iron condor will pay off. But if Micron makes a bigger than expected move, the trade will suffer losses. Remember that trades held over earnings allow for very little room for adjusting, so they can be pretty much hit or miss. But Micron has stayed within its expected range for the last 5 out of 6 earnings releases. Although we know past performance doesn't guarantee future performance, these patterns definitely help us weigh in on this decision. Please note that this information also is based off of Friday's option quotes. As always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money, and remember that options are complex and investors can lose 100% or more of their investment in some cases. Check out the new Options Trader app from IBD for digestible options education and tons of great trade ideas, and be sure to join us here for our regular options content where we break down a new trade idea every day.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.